Welcome to the Explainer. Okay, let's just get right to it. The crypto market is taking a nosedive, and pretty much everyone is asking the same thing. Is this the end of the bull run? Today, we're going to break down one investor's really fascinating strategy that basically ignores all the daily noise and focuses on one single hidden driver to plan all the way out to 2026.
Right now, the feeling in the air is just fear. Pure and simple. Everybody's trying to figure out if this is it, the end of the line for the bull market, or is this super painful correction actually just setting the stage for the next massive leg up?
And look, that fear isn't coming out of nowhere. Bitcoin has tanked over 27% in just 6 weeks. A drop like that is enough to shake even the most hardcore investors and send some serious shockwaves through the entire system. But this isn't just about Bitcoin's price tag. There's a much bigger wave of fear washing over the whole financial world, People are worried about an AI bubble, a slowing economy, just general uncertainty about what's coming next. We can actually see this fear in the numbers. The Crypto Fear and Greed Index is sitting at 15, which is deep into extreme fear territory. Just so you know, that's a level that signals widespread panic, the kind of thing you usually see right at the bottom of a market crash. The Altcoin Index at 25, it's telling a pretty similar story. But what if all of that, the daily price charts, the fear indexes, what if it's all just noise? The analysis we're diving into today suggests there's a much bigger and more powerful force at play that most people are completely missing. And that hidden driver is global liquidity. The best way to measure it is with something called the M2 money supply. Now, in simple terms, that's just the total amount of cash and other easily spendable money that's flowing through the global economy. Think of it like fuel for the economic engine. The more fuel there is, the faster everything can go. And that includes speculative stuff like crypto. So here's the absolute core idea of this strategy. Bitcoin isn't just a piece of tech, it's like a barometer for global liquidity. When central banks print more money and increase the money supply, that new cash has to go somewhere. And more, it's been flowing into assets like crypto, which, you guessed it, drives the prices way up. This sets up this really fascinating tug-of-war. On one side, you've got short-term market fear. That's driven by scary headlines, and it pushes prices down. But on the other side, you have this incredibly powerful long-term trend of governments and central banks injecting more and more money into the system, which has historically sent assets like crypto absolutely soaring. And what's really wild is that for the last 2 years, global liquidity has actually been shrinking. Yet, even with that huge headwind, Bitcoin has been incredibly resilient. This suggests there's this really powerful underlying demand just waiting under the surface. Demand that could totally explode if and when that liquidity trend finally turns around. Okay, so how does this idea about liquidity actually translate into a real plan? Well, to see where we're going, we first got to understand where we've been. Let's do a quick review of the 2024 strategy to see what worked, what didn't, and most importantly, what was learned. The old plan was all about diversification, right? Managing your risk. It basically split money into 3 different buckets: a core portfolio for the safer bets like Bitcoin, a mid-cap portfolio for projects that were promising but a bit riskier, and then a high-risk casino portfolio for those real long-shot speculative plays. So was all that diversification actually worth it? The results here are pretty interesting. If you had just bought and held Bitcoin, you'd have almost doubled your investment. This more complicated portfolio, though, it basically broke even. You had some massive wins like Ondo, but they got canceled out by total losses on things like TIA. Now, breaking even might sound like a failure, but this analysis sees it as a major win. Why? Because the #1 rule of this whole strategy is preserving your capital. In a market where that big altcoin boom everyone expected never really happened, this diversified approach protected the initial investment, and that made sure there was still money on the table to fight another day. And that powerful lesson in risk management is what directly informs this new, updated strategy for navigating the market from now all the way through 2026. It's simpler, it's more focused, and it's built on a whole lot of historical data. So the main tool for this new plan is something called a logarithmic chart. Don't worry, it sounds way more complicated than it is. Think of it like this. A normal chart sees a move from $10 to $20 as the same as a move from $10,000 to $10,010. But a log chart knows that first move is a 100% gain, while the second one is tiny. By focusing on the percentage moves, it just cuts through the noise and shows you the real long-term patterns.
And looking at the chart this way reveals the absolute core philosophy of the new plan. Trying to perfectly time the top of the market, it's a fool's game and it's only getting harder. But the historical data shows that the market bottoms tend to form in a much more predictable range. So the strategy just flips the whole script. Stop trying to sell the top and focus all your energy on buying in these historically proven value zones.
This whole idea then boils down to 4 really clear steps. Number 1, keep buying Bitcoin, the core asset of the entire crypto market. 2, for now, stop putting new money into the riskier altcoins. Preserve that capital. 3, build up a big cash reserve, your dry powder. And 4, get ready to use that cash by setting buy orders at key historical support levels. You're basically turning a market crash into your biggest opportunity.
And make no mistake, this is not a short-term gamble. This is a long-term plan. It actually anticipates that a potential bear market could last all the way until September 2026, just based on historical averages. So the next 12 months or so could present the key buying opportunities we're about to talk about.
All right, so where are these historical buy zones? The plan identifies the very first key level, the upper band of this value zone, at around $75,000. This would be a pretty big pullback, but not yet a total catastrophe.
Now, if the price drops through that level, the next major support zone is targeted at around $60,000. This level has been a huge psychological and technical battleground in the past, which makes it a prime spot to accumulate.
And finally, if we get a full-blown bear market, the ultimate buy zone is projected to be around $45,000. According to this plan, this isn't a moment to panic. It's the moment of maximum opportunity, and it lines up perfectly with historical models.
And you know, the real strength of this plan is just how robust it is. It completely removes the need to time things perfectly. Whether Bitcoin drops to these levels next week or next year, the target buy zones are already set. The core strategy, stacking cash and patiently waiting, doesn't change.
Which leaves us with a final question to think about. When the markets get this volatile, is the biggest risk the price crash itself, or is the real danger facing that crash with no money, no conviction, and absolutely no plan to take advantage of the recovery that eventually will come?